In another night of unusual action, US share market indices went in opposite directions in trading following the release of inflation data. The Nasdaq managed a modest gain for the night, but the S&P 500 and the Dow Jones Industrial Average both fell as pressure came across the board in response to worse than expected inflation numbers. And to give you some idea of why these inflation numbers rattled nerves, you can see on this graph the expectations in orange versus the actual numbers in blue. And up until now, the actual inflation data has been running below expectations as overall inflation fell. And that's a positive for markets. With inflation back towards the Fed's target zone of 2%, it gives the Fed the flexibility to respond to any poor developments in the economy and even in the market. But with inflation on the rise, it's much harder for the Fed to step up when things are looking grim. And the removal of that Fed support or potential Fed support was one of the reasons why investors reacted so poorly to the numbers. For the record, the headline rate rose to 2.7%. Market expectations were centered closer to 2.6%. And that big lift in the headline number was accompanied by a lift in the core reads as well. And that's why investors were so nervous with these numbers. It's interesting to note that we've been talking for some time in the lead up to this release that the bond market had been sending danger signals, and that continued last night. The US 10-year yield over the last week has sold off from around 4.25% to now be just a whisker below 4.5%. And while that might not sound like much of a move, in bond market terms, that's very significant. The level of 4.5% was where President Trump originally backed away from the tariffs imposed in April because the US debt continues to rise, and at close to $30 trillion in debt, the US simply can't afford to see interest rates continuing to rise while it tries to service that debt. So a move up from here for 10-year yields would start to weigh on government policy and therefore market sentiment, something to watch very closely. The bond market continues to send danger signals to equity investors. Now, there are some exceptions to this danger, and one of them was seen yesterday in the performance of the Hang Seng index. It rose by 1.6%, and in valuation terms, it's one of the most attractive major markets for global investors. The reality is it has not been stretched as hard as other markets, and particularly US markets, with those very glamorous tech stocks leading the way. For that reason, we could see further rotation away from some of those stretched valuations in Europe and particularly the US and into the Asia Pacific region, with the Hang Seng at the forefront of that. We are also well into the US earnings season, and it would have been very disappointing for shareholders in some of the major banks that reported last night, like JP Morgan and Wells Fargo, to see their share prices fall despite good reports, because we did see some good reports. Wells Fargo, JP Morgan, Bank of New York Mellon all reported better than 10% over analyst consensus forecasts, and Citigroup reported at 32% above the consensus forecast. So that sort of beat on earnings is very important. Now, the problem for investors was that of those 5 stocks, if we throw in BlackRock, the world's largest fund manager, of those 5 stocks, 4 of them fell in overnight trading. And it's a good illustration of an important investment principle. Share markets don't price what has happened in the past. Every single one of these reporters last night, all 5 of them beat expectations. It was the outlook that really drove the share market reaction. And while Citigroup certainly performed very well, it was their benign outlook that really worked for them. BlackRock, despite reporting a good increase in profit, fell hard, almost 6%, after it reported that its funds under management had fallen due to the loss of a big mandate, a big customer. And so the share market didn't care about the better than expected quarter that they just had. It's concerned about the future. As always, it's future earnings expectations that are most influential on share prices. We've got a chart here for us to have a quick look at, and you can see what happened to BlackRock in light of that result. And also, perhaps disappointingly, how well it had travelled in the lead up to this report. And it does look very much like a classic case of buying the rumour and selling the fact in BlackRock. Looking ahead, we've got more reporting coming up. We're right into the meat of the reporting season now. The last 2 weeks of July often contain a lot of clues. Tonight, we've got more financials reporting, including Goldman Sachs. We'll also hear from Johnson & Johnson and General Electric, or GE as it's called now. And so these three companies in themselves, a bank, the retail group, and a industrial conglomerate, together will give us a very good read, not just on these individual companies, but on the health or otherwise of the US economy. And looking at the leads we've had from the banks so far, it does look like the risks in the reporting tonight are on the upside. Now, the ASX was hit at the open this morning in response to that selling, generally in US markets. It was the macro that is concerning investors more than the earnings reports we're seeing. We're seeing pressure across the board. We were expecting before the open to see more pressure on the global miners, given that we'd seen share markets drop and we'd seen commodity prices tumble as well. It didn't work out that way. The hardest hit in the early trading was Newmont, the global gold miner. It suffered the double whammy of a falling share market and a falling gold price, but others have held up well. And one I'd like to highlight this morning is Rio. Its share price is holding up very well this morning, despite the fact that we've seen so much pressure in that area. It may well have a tumble to come, but at this stage, it's outperforming the broader market.